Hey everyone, welcome to another episode of AdMaill. This is Adam Bergman, founder and CEO of IRA Financial. I'm here to help you find the answers to the most frequently asked questions from my clients about self-directed retirement accounts. If you want to learn more, you can subscribe to our YouTube channel and follow us on social media. Just search IRA Financial. Hey everyone, Adam Bergman here, tax attorney and founder of IRA Financial, and welcome to another episode of AdMaill. This is episode 10, Prohibited Transactions. And actually on today's podcast, I'm going to actually only answer one question. Why? Because it is a very, very detailed question. And essentially the question wants me to go through each of the prohibited transaction rules under 4975C and give examples of how it works, how it applies, and explain it in very simple terms. So I figured, you know what? Let me take 6-7 minutes, and instead of only giving this question 2 minutes, I'm going to give it the full 6 to 7 minutes and really go through each of the prohibited transaction rules. Since this will probably be the last episode on the prohibited transaction category for now, I'll come back to it obviously throughout the year and different variations on different questions. But I think right now it's going to be important if I just summarize and go through the 4975 prohibited transaction. So what I'm going to do, and if you're listening to this on wherever you're listening to my podcast, whether it's Spotify or Apple or wherever, that's cool. But if you want to actually follow me and go through the tax code under 4975C, you can check out our amazing YouTube channel, and we'll send a link in the show notes, so you can just click on it. And from there, you can check out the video of this podcast. And what I'm going to do is go through the 4975C prohibited transaction. So if you are watching on YouTube right now, you can see my screen. And this is 4975. This is just the actual tax code, just online. Cornell Law School, they actually, for many years, they've basically provided the updated tax code online for free, so we all can look at it. So here's 4975. This is directly from the tax code. We're going to look at C. C are all the prohibited transactions. D are all the exemptions. We talked about, D1 is a solo 401k loan. D13 is ROBs. Here's D13 and ROBs. But let's focus on 4975C. And what I'm going to do is just spend the next 3-4 minutes going through each of these provisions in very simple terms, and we'll provide an example so everyone understands 4975. Not that you don't, if you've been listening to this podcast for the last 10 weeks, hopefully you have a very in-depth knowledge base of the prohibited transaction rules, but nevertheless, let's go through them right now. So just before we jump into them real quick, in order to have a prohibited transaction, there's 3 types of prohibited transactions for IRAs. 2 are found under 408. That's life insurance. You could buy it in a 401k, not in an IRA. And then collectibles, which are antiques, rug stamps, baseball cards. There's an exemption for precious metals like bullion coins and bars, silver, gold, palladium. Just remember, metals and coins must be held in physical possession of a U.S. depository, U.S. trustee, not in your own personal possession. And then there's 4975C, which is the broadest category. And essentially, in order to trigger a prohibited transaction under 4975C, you need to have 2 parties. You need to have a retirement account, like an IRA or 401k, and you need to have a disqualified person. Okay, and a disqualified person under 4975E2 is essentially you as the IRA fiduciary, your lineal descendants, right? Here's you as a fiduciary, your lineal descendants, any entities controlled 50% or more by such persons, right? So parents, children, spouse, daughter-in-law, son-in-law, or lineal entities, whether it's a corporation, partnership, LLC, trust, 50% or more by a disqualified person. And then if you get into a situation where you have an entity that's 50% or more by a person, whoever owns 10% or more of that entity or is potentially an executive of that entity would also be a disqualified person. So for example, if I own 60% of a company and I have a 10% partner, that partner is disqualified to me, meaning I can't just lend that partner money from my IRA for him to go buy a car or a house, because the concern from the IRS perspective is that that money will somehow find its way back into the company since we're disqualified people because of our business relationship. So let's get to 4975C. Again, you need a retirement account and a disqualified person. So the first three are easy. Sale, exchange, or leasing of property between a plan and a disqualified person. Basically you can't sell your house to your IRA, or your IRA can't sell a house to you or your lineal descendant. That's obvious. B, lending of money or other extension of credit between a plan and a disqualified person, right? I can't lend money from my IRA to my kids. Again, lineal, parents, children, spouse, daughter-in-law, son-in-law, or any entity controlled 50% or more by such persons. This is where you can't have a credit card for your IRA, right? Because you can't extend credit, personally guarantee an obligation in your IRA. C, furnishings of goods, services, or facilities between a plan and a disqualified person. Notice it doesn't say anything about compensation. So you just can't provide services. Just keep in mind 4975-6 under the Treasury regulations allows the fiduciary you to provide obviously necessary services like picking an investment, right? Choosing the house you're going to buy, choosing the tenant. What are you going to sell it for? Is the paint going to be white or green? Picking a lawyer, picking an accountant, picking an advisor, right? You can do the basic stuff that any investor needs to do in order to facilitate an investment and manage it, but you can't do what's not necessary, like fixing the toilet, right? Or mowing the lawn. Like that, you need to have a third party do. Now, D, E, and F are basically, I call them catch-alls. They're like wild cards. This is what the tax court and the IRS uses. Well, not tax court. This is what the IRS uses in tax court to basically try to show an individual taxpayer did a prohibited transaction. Note, there are not many prohibited transaction case law substance out there because this is not a type of pursuit the IRS tends to facilitate. Why? Because there's no specific IRS audit division for IRAs. There is a 401k, not for IRAs. It's also a public policy perspective. And 99% of Americans don't do bad stuff with their IRA. So spend all these resources to try to catch a few people doing some bad things. Generally not good, wise use of government money. So D, E, and F, if there is case law, and we'll go through this case, Rollins v. Commissioner, which is one of the, I think, principal prohibited transaction cases, and really show the application of D, E, and F in a second. So D says the transfer to or use for the benefit of a disqualified person of the income or assets of the plan, right? So this is broader maybe than A, where you sale or exchange. Here you can use indirectly, right, benefit of a disqualified person, right? So transfer to or for the benefit of a disqualified person of the income asset. So maybe you have a situation here where you have a real estate asset in your IRA and you use some of that income maybe to pay your kid as a contractor or a realtor or something like that. So it's more of an indirect benefit. E, act by a disqualified person who's a fiduciary. So you have to be a fiduciary to trigger E and F. D, you don't have to be a fiduciary. So this could be triggered by someone else, right? It could not you, could be a brother, child, spouse, could be a company. Here it's a disqualified person who's a fiduciary, whereby he deals with the income or assets of plan his own interest. This is where you take your IRA money and maybe invest in a company you own 50% or more of, or a situation where somehow you're benefiting from your IRA investment as the fiduciary. And then F, receipt of any consideration for your own personal account by any disqualified person who's a fiduciary from any party dealing with the plan. So it's like a third party situation where maybe you take a job with a company, and in order for you to secure your job, you have to make an investment into the company and use your IRA to make the investment. But it's dependent on your job, because if you don't make the investment, you don't get your job. Kind of a conflict of interest. So Rollins v. Commissioner, an important case, 2004 tax court case. This guy Rollins was an accountant. He owned a bunch of companies, all under 50%. He didn't work in any of these businesses. The companies needed money. He took his 401k and lent the company money at prevailing interest rates. The IRS argued prohibited transaction. He said, what are you talking about? Look at 4975E. I own less than 50%. There's no disqualified person here. I win. And they said, well, actually, no, you don't win. It's your responsibility to prove that you did not directly or indirectly benefit. And they use D to say transfer to or use by for the benefit of a disqualified person. And their argument is that if you did not loan the money from your 401k to these companies, the companies would have potentially gone bankrupt and you would have lost your personal investment. Hence, you indirectly or directly benefited from the transaction. If you look at on top, it says for purposes of the section, the term prohibited transaction means any direct or indirect, right? So it's a direct or indirect. And they use D, and D is their catch-all. E, again, has to involve a fiduciary, which could be an advisor, or could also be you as the fiduciary of your IRA, where D could be companies, it could be non-fiduciaries, children, spouse. So D is definitely broader, and Rollins is a great example of how the IRS used D to go after Rollins, and the tax court actually agreed, which I actually don't agree with the ruling. I think it's an incorrect ruling. But he didn't do a good job, Rollins, defending himself. I think if he showed that there were other opportunities for the companies to raise money, he didn't have to lend the money to the companies. He could have gone to a bank or other third parties. I think the result would be differently, and the tax court maybe would have ruled in his favor, but unfortunately, that wasn't the case for him. So essentially, this is it. This is A, B, C, D, and F. These are the prohibited transactions in a nutshell. To sum, remember, you need, in order to have a prohibited transaction under 4975C, you need a disqualified person and you need a retirement account, right? And then 4975A, B, and C talks about some of the direct relationship services, for example, or transfers, extension of credit, where D is the broader direct or indirect benefit. And then E and F talks more about like self-dealing and conflict of interest involving a fiduciary. So that's it for the prohibited transactions. They're not super complicated, but there are certain elements that you need to be aware of, which is another reason you need to work with experts, right, to navigate these rules. And that's why I think, IRA Financial, I'm so proud of all the work we've done over the last 15 years and helping 25,000 plus clients invest almost $4 billion in alternative assets, because I think we do better than anyone in terms of speaking to all our clients and wanting you to call our experts. And we have daily training where I go through and give classes to our team. I've written 9 books, and I make sure everyone reads at least the key books in their area of focus, and that's important. We're always up to date in new rules, regulations, and cases involving the IRS and prohibited transactions involving the retirement account. So that's it for today. I hope you enjoyed today's AdMaiL 1 question. It's the first time in like 5 years I've done only 1 question. So I hope you enjoyed it. A lot of fun, and look forward to seeing everyone again on the next podcast. Thanks.